I want to address the two topics in hand that are going to affect your finances. Firstly, the banning of Carvy by NSE as well as BSE. And secondly, of course, the priority that mutual fund holders and mutual fund companies will get when it comes to the refund of DHFL's dues, which begets another question. But first, let me talk about the entire Carvy issue. It's one of the biggest brokerage firms in India, and now, of course, the two major exchanges in India, NSE as well as BSE, have banned Karvy. What are the lessons? What are the implications for all the individuals that held accounts in Karvy? That's what we want to discuss with Kaushalendra Singh Sengar of advisorymandi.com and Harsh Rungta, our personal finance expert. So, gentlemen, thank you so much for joining us on the Money Show. And Kaushalendra, I'd like to start off with you first. Let's talk about what will a ban by exchanges on Carvy's accounts mean? Like we mentioned, there are more than 2 lakh active accounts with Carvy. So what exactly is the implication? What does it mean for those account holders? What will happen to their accounts?
So, the reason of happening this Carvy scandal and all these things in the market is mainly because of brokers are not able to meet out their cost in the market, and high cost is making them unable to run the whole system. So reason of all this happenings that either clients are not literate enough about the stock market, and more than 90% of investors even don't understand the depository statement and all, and broker are not able to meet out the cost survival. So this is the main reason what I think for the mishappening happened with the clients of Carvy. So as per the SEBI instruction today, that most of the clients are getting their stocks back in their demat account. Around 83,000 clients has received their stocks back in their depository. Rest 7,000 clients stocks are still due, because as per Carvy there are some charges which is still due, which they need to collect from the clients, and then after they will settle their amount and their stock holdings.
So 7,000 clients as well, they will get their shares, right? I mean, what I want to understand is it won't be delayed, or it's not possible that it won't happen, right? Because eventually, Carvy essentially is waiting for the other clients to pay up, and hence it will be transferred to those remaining 7,000 clients, right?
Yeah.
Okay. All right. Now, of course, this begets the question, the lessons that investors should... Sure, go ahead, Kaushalendra.
Yeah, so as per the balance sheet, if you can see, the Carvy Financial Service is having a total asset of 556 crores and equity surplus of 410 crores. So they are in a position to repay the client's money. I don't think there will be any problem.
Okay, fair enough. Now, of course, this brings the question that what exactly should investors check for? What is a checklist of sorts that this Carvy case has brought about as a lesson for all investors to understand from? So, Harsh, I would like to then ask you that question. What's the mistake perhaps that investors made when they continue to hold their accounts in Carvy? The telltale signs of sorts that they ignored. Harsh, what would you recommend investors should ensure they look at when choosing their brokerage partner?
With a lot of convenience comes a lot of responsibility. The convenience is that when you give a power of attorney to the broker, so that as and when you buy, or primarily as and when you sell from your shares, he is able to take it away from your depository account and transfer it to the pool account. He's able to use the shares to raise money or get margin funding for you. It's convenient, and therefore most people sign on the dotted line. And I don't really think there is too much that too many people do. What you could probably do, and if I was to give a parallel example, is, let's say you use a safe deposit vault at the bank. Now that contains valuables, and when you go and operate a safe deposit vault, one thing that you ought to always do is look at because you will have to sign a register, and at that register you should always look at who are the other people who have used access to that vault, and that obviously has to be the people who are authorized, typically mostly you and your spouse. And so you can have a quick look to see that. I think similarly, for a demat account, you ought to look at it periodically, maybe once a month, once in a quarter. And typically, if any shares have been transferred out or have been pledged, and both entries will show up separately, you should examine them to see if there is any issue. If that is too much for you to do, or you're not able to do, then I think you have no choice but to pay attention to these pesky little SMSs that come from NSDL saying so and so shares transferred from your demat account, so and so shares pledged. Pay a little attention. I think when you do a transaction, I'm talking of inactive investors. I think active investors do it anyways, but by and large, most lay investors are inactive. Pay attention to the SMS. And if you don't get one when you should be getting it, or if you get an SMS when you should not be getting it, both are, I think, warning red flags that you should look at. I think there is no choice. With great convenience comes great responsibility. I think that is the only thing that I can say.
Like you mentioned, Harsh, that for guys who are trading, etc., they do their regular reconciliations. They ensure that the shares are transferred from, the depository, CDSL, so on and so forth. But I think, Mr. Sengar, that's where the issue arises, right? We don't often do that reconciliation which is required. So now, how can investors essentially look at their depository statement? I mean, I'm sure there are lots of resources available online that we don't know of. So if you could explain the process of how I can get my, depository statement and then compare it with what the brokerage is telling me I have in my account.
So you can register yourself with the depository portal, either it's CDSL or NSDL, as per the broker's tie-up with their depository, and you have to create an account with them. Then they are sending you a statement periodically on a monthly basis if you are an active user and you are doing transactions. And if you're not doing transaction, then they are sending you a statement on every 3 months. So you have to match your broker's holdings with your depository transactions. Not specifically, focus on the amount of holding you are carrying. You have to check the amount of shares you are holding. So you need to cross check the quantity rather than checking the market value of that shares. Right. Rest, I have a suggestion for the depositories wherein we can stop these kind of activity in future. So suggestion is that broking industry is still lacking in terms of technology, be it exchange or brokers. Major deposit need to take while doing any transfer in a demat account, or need to share a OTP to the register mobile number of the accountant. So if somebody is doing a transaction on a depository account of any user, either it's broker or even the client is doing, then what I suggest, there should be an OTP which have to come to a client register mobile number, along with the detail that how much share they are transferring and what will be the balance share after the transaction. So this OTP will directly come to the concerned owner of those depository account, and only when that concerned owner is allowing or transferring this OTP to the broker or giving that OTP to anyone, then only transaction can be happened. So in this way, user can track these kind of activity, that something is happening in my account and it is with my concern. Okay. So this is a simple suggestion wherein we can stop all these kind of activities in future.
All right. Okay. Mr. Sengar, of course, even mutual funds as well would be attempted by this scam, right? So would mutual fund investors as well have a reason to worry on this point?
I don't think so. Mutual fund investors have to worry about all these things, because fund managers are quite active and they are already tracking all these kind of activities and diverting the portfolios and taking a correct measure at right point of time. So they need not to worry about it. I don't think so.
Okay, so MF holders don't need to worry. And Mr. Sengar, just one last question from my side. As we know now that NSE, BSE has essentially cancelled Carvy's license, it means that now all the account holders will have to shut shop on Carvy and move to another account, to another brokerage firm. So as they do that, if you could give us a checklist of what they should watch out for when they're choosing their new brokerage firm, so perhaps the process will be easier for them when they have to pick another brokerage firm, because once bitten, twice shy.
So to identify broker, they need to check the broker's balance sheet and the holding. If it's debt free, like Zerodha is a debt free broker, so I really recommend that thing. And if they are choosing any banking broker, so banking broker is following good compliance, because they are following the compliance of RBI as well, and taking the compliance of SEBI also. So these are quite safe from my point of view. Rest, they have to check whether broker is doing regular settlement, because as per the SEBI, if whatever idle money you have in your account, you have to settle those money within 90 days to the client account. So if broker is doing that, it's good. They have to check whether broker is providing a trade confirmation through SMS. If brokering is doing that, so it means broker is following the compliance, right? Rest, they have to check whether broker is doing a weekly reporting of the client wise holding to the respective exchange and fund balance. And when broker is doing these kind of reporting to the exchange is providing the same SMS at the end of the day to the client to cross check that you are holding these number of shares along with the this is the total amount of shares you are holding, right? And last thing is that monthly reporting broker level financials. This is a enhanced risk based surveillance. This reporting ensure that broker does not use fund or shares of the client for other clients for their proprietary trading. So all these checklist user need to check with the broker before opening an account with them.
Okay, now let me get back to our DHFL topic. We've brought Mr. Harsh Roongta for the same. Harsh, thank you so much once again for staying on with us. Apart from Karvy, the DHFL issue as well, that's hurting a lot of individual investors. So let me start off first by asking that DHFL has gone in for bankruptcy, and it doesn't look like the mutual funds that own DHFL paper or are exposed to DHFL in any way are going to be high on the priority list for getting a refund. So as mutual fund investors, should I be worried about the fact that my AMC has a certain percentage exposed to DHFL in any way, and now that it's going in for bankruptcy? I mean, as a direct holder, obviously I have every reason to be worried, but as a mutual fund investor, how worried should I be that my fund as well has a certain amount of its AUM invested in a DHFL asset?
See, obviously, if you are holding any debt scheme or any scheme for that matter that has exposure to debt papers of Diwan Housing, then obviously those would have already been written down already. That would have happened. And I think therefore to that much extent you should be worried. And why only Diwan Housing? I mean, there are a lot of stressed papers out there. But strictly speaking practically, I don't think it is really possible for a lay investor. I'm talking of a lay investor. We are not talking major corporates who have treasury departments and things like that. We're talking of a lay individual investor who might invest a few lakhs in certain schemes or few thousands in certain schemes. For them to be able to keep track of underlying securities, especially in debt, please understand that even Diwan Housing till maybe about 1.5 or 2 years ago used to be AAA rated. So very, very clearly, there is no real warning that happens before a debt progresses from above investment grade rating to default rating in India. I mean, the scale is really, really fast. The speed at which it gets downgraded is really, really fast. So I don't think it is possible. I think what is possible is to understand the risk that you are getting into. So if you do not want the risk that some of the papers in your scheme will not be paid back, a credit risk, okay, then invest only in the kind of funds like liquid fund or an overnight fund or a banking or a PSU debt fund or probably an arbitrage fund. I mean, invest only in funds where the risks are low. Another risk that very few people know about is the risk that the value of your mutual fund units will fall when interest rates rise. I mean, that's called interest rate risk. I mean, that also is a risk. Again, if you feel that risk is not something you want to take, the same set of funds that I outlined earlier, except the banking PSU debt fund, the liquid fund, overnight fund, or the your arbitrage funds, those are the funds that you ought to be investing in. I think understanding and keeping your expectation in control. If you want a return that is in excess of a liquid fund or an overnight fund, it comes with risks. I think knowing that and expecting that is something that is most important. I think corrective action after securities have been marked down mostly will be like closing the stable doors after the horses have already bolted. I think a lay investor really cannot do active management based on the underlying portfolio of the schemes. Which kind of schemes to invest in is something that he should definitely be doing.